But let's say you're in industry and you can't get it anywhere else. Well, there it is. Stand for delivery. So that implies, but doesn't guarantee, that the supply chain, I wouldn't say is breaking down, but more than the usual amount is coming off the COMEX, which implies, again, I can't put it into a proof formula that we're looking at more silver taken off, because it really is a place to go to get it, especially in a timely manner. Maybe you called up a refiner and said, hey, we're at this level and it's going to take, 4 weeks. Really? Okay. Well, I could get delivery next week if I just stand for delivery or whatever. So again, I'll make it an implication. I'm wearing a hat. You can take it for what you want, but that's what it shows me.
Physical investment is a structurally important part of global silver demand and the most volatile. Notably, over the past 15 years, physical silver investment has ranged between a low of 157.2 million ounces in 2017 and a record high of 337.6 million ounces established in 2022. Silver is up 34% year-to-date, outpacing the gains of gold and Bitcoin, driven by growing debt concerns, geopolitical tensions, and its perceived undervaluation. COMEX is not a supermarket for silver, it's the last resort. The fact that more and more silver is being withdrawn from it may be the most important signal in the entire market. DavidMorgan warns that this may be an early sign of a supply strain, similar to past shortages in commodities like palladium, which triggered a shocking price spike. For silver, the first 5 days of the August contract saw 1,721,192 ounces delivered, while 1,890,316 ounces were withdrawn from warehouses, meaning more metal left the system than entered it. These figures represent more than just statistical anomalies. They signal a potential sea change in market participant behavior and priorities amid the ongoing gold market outlook. In the paper futures market, 99% of contracts are just a bet, but in silver, a hidden war for physical metal is raging. Morgan also recalls that after Warren Buffett bought nearly 130 million ounces of silver from COMEX years ago, the exchange imposed limits to prevent a single buyer from draining supplies. The COMEX futures market has historically operated with less than 1% of contracts resulting in physical delivery. Most traders simply rolled positions forward or settled in cash. This long-standing pattern has dramatically reversed in recent months, with delivery rates reaching 100% in certain contract periods. A total collapse of the US dollar is unlikely, but DavidMorgan warns that a transition is inevitable, with smart money already buying gold and silver in a crack-up boom that will redefine everything. Before we dive into DavidMorgan's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Last week, I talked about the ebbs and flows in the silver market. So going back to the big picture. In the futures markets, if you look at the softs like cocoa and cotton, or you look at the ags like wheat and soybean oil, or you look at the metals, any of those sectors, usually you only get about 1% of the total that actually gets a delivery against the contract. So 99% of the time, you're just pushing paper back and forth. And that's what the futures market is. It's a derivatives market where settlement is almost always in cash. There are exceptions. There are deliveries of cotton and cocoa and silver. So on silver specifically, we have seen a big change over the last year or so. And this was primarily, and there's arguments about why the silver moved from London into the COMEX, but it's primarily an arbitrage opportunity. And the big players that own the silver physically are able to take these boatloads of silver and move it from a location to another location and still make a spread on it. So that's what happened. And the inflows and outflows have just been above normal. I mean, anyone that's objective and can count knows that that's a fact. In fact, in the weekly perspective, I believe last week, I went through the numbers. I don't have them memorized, but we've had a significant more activity in and out of the COMEX over the last, like I said, year or so. And I did note that, I watched the flows rather carefully, not as avidly as I used to, but I still pay attention to it. And whenever we got to the registered category, which is the amount of chips that the registered category, being the dealers, have available, when that gets thin, it's like playing poker and you have a big stack of poker and you're losing the game, and all of a sudden your stack goes way down. And that indicates that they don't have much physical silver to deliver into someone standing for delivery. And it got down to like the lowest level I'd seen in a very long time, and it stayed there longer than I'd ever seen before. And I made note of that to my subscribers, and probably publicly, I don't remember. And pretty much after the words were out of my mouth, we start to get this huge build in the overall categories, primarily in the registered category, and primarily from the LBMA. So those are facts. But the one I want to stress is after Warren Buffett bought 129.7, rounded up to 130 million ounces off the COMEX, he actually only delivered 90 million instantly. And he took, the offer, I guess, to get the rest, the other 40 million over time. And if I remember correctly, someone can check me, but I think it was after that. I'm pretty certain it was after that. There was a limit on 7,500 contracts that you could take off the exchange. Now, I think that's gone away because we haven't seen that in quite some time. But the exchange is kind of protecting themselves because they wanted to prevent someone coming in and buying up the whole silver supply and saying, all right, we're standing for delivery. So whether that holds now or not, I just want to bring that to everybody's attention. So the bottom line is this. It is a fact that the ebbs and flows in silver, gold as well, through the COMEX has been greater these last years or two than it has been previously. That's just a fact. Whether someone says it's normal, I'd say it's quote unquote normal in air quotes, as long as everybody that stands for delivery gets their silver or gold in a timely manner, then yeah, of course it's normal, because it's supposed to be, as stated, available to anyone who stands for delivery to get the product, whether it's cocoa or cotton, soybean oil or silver. In most cases, you got these, we'll call them large pallets of silver, 1,000-ounce bars. And on that whole pallet of however many bars there are, I never counted them, there's a tag that says HSBC. And then someone stands for delivery and they take off the HSBC and they put on JPMorgan on it, and the silver never moved. But ownership did, but it never left the warehouse. The only way to track that is to see how many semi-truck trailers come in there and actually take it outside of a COMEX warehouse. And that part of the activity has changed as well, more than before. I mean, just on the input, when you're sitting there and all these, semis pull up to COMEX warehouses and there's more than one of them, and delivers 1,000-ounce bars, and someone's got to, take a forklift and move them in and put them in a pallet or on a shelf. That is a physical movement that increases the silver supply. And that's what took place. So someone say that it's all a paper change is incorrect in this instance. What it indicates to me is that I looked at the COMEX once I understood how it really worked, with 99% just being a paper push, that anything that came off had some substance to it, because I look at it as, and you don't have to agree, it's kind of the place of last resort, the last place you're going to take the silver, and not necessarily, but it's certainly not the first place. I mean, anyone that's in the industry, be it a fabricator for silver shot or screen or wire or all the different fabricated things that silver goes into, which is vast, they get it usually direct from a refiner or smelter, and they do what they do. They don't ever take it off the COMEX. And so who takes it off the COMEX? First of all, very few, but those that do usually are for investment purposes, but not always. But let's say you're in industry and you can't get it anywhere else. Well, there it is. Stand for delivery. So that implies, but doesn't guarantee, that the supply chain, I wouldn't say is breaking down, but more than the usual amount is coming off the COMEX, which implies, again, I can't put it into a proof formula that we're looking at more silver taken off, because it really is a place to go to get it, especially in a timely manner, maybe you called up a refiner and said, hey, we're at this level and it's going to take, 4 weeks. Really? Okay. Well, I could get delivery next week if I just stand for delivery or whatever. So again, I'll make it an implication. I'm wearing a hat. You can take it for what you want, but that's what it shows me. And this has happened in others. I mean, there's others. It's called rapeseed oil. It's really canola oil. And there was a shortage a long time ago, and that market went just absolutely ballistic, like palladium did at one time. But it was what I call popcorn rally. It went from here to almost straight up. The deliveries were made, and it came right back down. There's an old truth at our peril: when money loses its integrity, freedom soon follows. Throughout history, the erosion of honest currency has marched in lockstep with the erosion of civil liberties. The connection is not coincidental, it's causal. Because money is not just a medium of exchange, it's the lifeblood of voluntary action. When it's corrupted, everything downstream begins to decay. Professional agency, self-reliance, and ultimately freedom itself. In a truly free society, individuals make decisions based on trust. They trust that the fruits of their labor, measured in quote-unquote currency, will retain value over time. They trust their savings will serve as a source of wealth, not a melting ice cube. They trust investments will respond to real-world fundamentals, not the whims of unelected technocrats operating behind closed doors. So it's a rigged system. I go into what you just alluded to with Venezuela, the Weimar Republic, and you lose basically your freedom and you get a tyrannical government and civil unrest. And that's the direction we're going toward. And to back up, Catherine Austin Fitts, it talks about, all the people that talk about the dollar is collapsing or failing. It is failing. I think I push back on that word, and I'm not sure she even uses that word. I mean, it's worth about 1.5 cents of what it was in 1913. So certainly holding its value, which is one of the mandates of the Federal Reserve. It's done a miserable job. Whether it'll fail completely, I highly, highly doubt that. I do believe that we will transition into a new system before we get a complete failure. But that doesn't mean that the market won't react as if it's going to fail completely. And that's where you get into what von Mises calls the crack up boom, where I'd rather buy, 5 jars of peanut butter and some tuna fish rather than keep the currency, because I know that, or believe that currency is losing value so rapidly. I'd rather have something of value rather than hold the currency itself. Will we get to that point or not? I don't think we will get to that point on a mass psychology basis, but I think we're already seeing it, as you alluded to, from the bigger players, the smart money, like what happened with gold. When I said the run to gold has already begun, which I was correct. And we saw the major central banks buy gold at a substantial rate above and beyond what they'd done in the past over the last year and a half or two. And now we're starting to see it in the silver market.
Since returning to office in January, he has lambasted the Fed publicly and relentlessly, calling its chairperson, Jerome Powell, a moron, a numbskull, and a disaster, and accused the central bank of damaging the U.S. economy by failing to cut interest rates. According to DavidMorgan, sound money is a moral imperative because when the state controls the money, the Genius Act, a new law for stablecoins, is a financial sleight of hand and really a backdoor to a private-public partnership with the same central control as a CBDC. The only hope is at the state level, where sound money laws restore our right to choose real money and resist financial tyranny. The passage of the U.S. Genius Act in July 2025, creating the first federal framework for stablecoins, and China's rapid deployment of the ECNY alongside its wholesale cross-border central bank digital currency, M-Bridge, have brought the paradox to the heart of the international monetary system. The stakes are high: control over trillions in cross-border payments, the effectiveness of sanctions, and the balance of economic power in a digital world. The U.S. system of checks and balances is at a breaking point. With executive orders increasingly pushing the limits of presidential power, the lines between the branches of government are becoming increasingly blurred. This erosion of constitutional balance represents a historical tipping point, as seen in past empires. Let's get back to the interview.
Well, in that light, the defense of sound money is huge financial concern for everybody. Everybody's worried about their money, whether it's yen or euros or dollars. And it becomes a moral imperative that currency holds its value. It empowers people to live independently, to think long-term, and to resist coercion. It protects sovereignty, both national and individually. Remember, sovereignty simply implies the capacity for self-determination. In other words, you're not ruled by an authority that commands what you can eat, where you can go, what you can say, and what you can do. And gold and silver have served that role for thousands of years, not because they're shiny, because they're scarce, verifiable, and resistant to centralized control. When we have the ownership of money, then we have control. When they own the money and dole it out, they have control. So the digital currency offers new tools to the control mechanism under the guise of convenience. And the battle over money is reaching an inflection point. Who controls it? Well, the banks do. And as they control it, it worsens our ability to make our own free will decisions. And that's just the way it is. So I end that with, we will continue down this path of dependence and dilution, or will we reclaim the principles of honest money and with them the promise of a truly free society? The answer is determined far more than a piece of gold or return to your portfolio will determine whether future generations are a free people or managed subjects of a technocratic financial system designed to control, not liberate. So now I absolutely agree with Greg. I mean, it was the sleight of hand, look over here, look over here. No CBDC, no CBDC. But they put it in over here under a different guise called the Genius Act and let JPMorgan issue it, or Amazon, or both of them. So they're going to get to it in the public-private partnership rather than the central bank. So what? It's still the same control mechanism, no matter who labels it or who issues it. If you're forced to take it, like you are now with the legal tender laws, and you can only make payment in their script and you do it by force, you don't have a choice, then, of course, they have the control. Now, on that point, being a member of the Sound Money Movement and being on their board, their advisory board, there has been pushback by the states. I think there's something like 16 states now that have some level of honest money in the system. And in some cases, you can actually pay taxes with gold or silver. And I think there's only a couple states that allow that. But this is a pushback mechanism that we are putting in what I said in an essay, that if you have the ability to determine your own financial future based on a choice of which quote unquote money you use, now we're getting power back into the people. At least they have the opportunity to determine for themselves how they want to transact in the monetary realm. So it's not over till it's over. And we do have the ability. And there's many people out there. I mean, if you talk to someone that's never watched Liberty and Finance and they really don't understand how the monetary system works and how much control it has over people, probably wouldn't give it a second thought. The credit card works. I get my Starbucks every morning and I'm happy. Why should I even worry about it? Because they don't understand history and haven't had the time or inclination to look at it. I mean, as you outlined, I think that the administration may know that they're breaking the boundaries and they're doing it deliberately, maybe with thought. Some people won't agree with me, asking my opinion. This is opinion, people. And I think he's doing a lot of executive orders, a lot of things that are pushing the boundaries of what his true powers are. Not his Trump's, but the executive branch of government. And it's testing the whole system. It looks to me, my opinion, that the boundaries between the legislation, the judicial, and the executive are being tested left, right, and center. And we're seeing what the judiciary has done with a lot of these charges against Trump and, being dropped or dismissed or held or whatever, fines and then fines dropped. I mean, the whole thing is being put into question right before our eyes. It's not like a philosophy class about U.S. government. We're watching it. I mean, to tell this lady she's fired because she used her primary residence twice, which isn't right, and the law is supposed to be equal. I mean, the whole thing about the Constitution is it's supposed to be we're all equal. It doesn't mean equal in physical ability or intelligence or skill sets. It means equal under the law. So it doesn't matter if you're the president or a janitor or a ditch digger or a farmer or a miner or whatever you are. we are treated the same equally under the law. So if someone used a primary residence twice, two different residences and called them both primary, you can only have one. They did something. Now, whether that gives Trump the ability to fire or not, I would question that highly. But he did it anyway. So I'm going on, but I think the whole system is being tested, not only on the monetary level, through the three branches of government. And we're getting to a tipping point, as far as I can tell, where all great empires get. And that's where they start to fail. And people themselves start to look to the powers that be and say, what's going on here? This isn't right. This isn't correct. We never had this before. What's happening? And then we get a new regime. And in the past, the new regime has been more authoritarian. And that, of course, is not what I'm shooting for. I'm shooting for more freedom, not more authority.
Silver has been quietly building momentum in the precious metals market, with technical indicators and market performance suggesting a potentially significant rally ahead. As of late August, silver was approaching the $39 mark, positioning itself for a potential breakout above the psychologically significant $40 level. This price zone represents an important threshold that, if breached, could trigger additional buying interest. If silver prices snap higher, the shorts will get slaughtered by relentless margin calls, forced buy-ins, and lockstep panic that will send prices vertical. In this scenario, owning paper silver is a death sentence, but owning physical is a coronation. If physical silver truly becomes the linchpin in a monetary transition, will investors recognize the warning signs in time? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.